Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host Jordan Rochester from the Global Markets Research Team, and in this episode of our Fireside Chat, I'll be talking with Craig Chan, our Head of Global FX Strategy, and Albert Leung, our Asia Rate Strategist, on their thoughts for the long-term and short-term China views going forward. I'll be asking them both, what does the dual circulation strategy mean for the renminbi? What are the plans for the internationalization of the renminbi itself? And how does this feed in, and what does this mean for the flows in FX and rates markets? First of all, hi Craig and Albert. It's great having you both on again, as we've got a lot to talk about in regards to China. There's naturally a lot of focus on the near-term impact of COVID-19, but it's actually been nearly a year of that now, and we have to make sure we capture these big structural trends that are taking place in the background that could actually come to define the post-COVID-19 era too. And one of them is the recent push by China with its dual circulation strategy. I remember we did a podcast on this just a few months ago, and it's worth a refresh of it. We've got the National People's Congress coming up. We're recording this on Thursday before that happens. And the sort of changes we've seen in policy since that podcast as well, I want to talk to you about too, and what that feeds through to your FX and rates view. So Craig, just as a reminder for folks listening at home, what is China's dual circulation strategy?
Yeah, thanks, Jordan. So, China's dual circulation strategy, it's a plan. It's been something that's rubber stamped by the top leadership in China, and it's really to create a more kind of self-sufficient country. So that's it tapping on its own domestic market, and it's innovating, moving up the value-added chain, particularly in manufacturing. That's something that they're going to develop, and they've highlighted already in terms of the semiconductors, kind of electronics, high-end value-added manufacturing that they're pushing for. So I believe that this is something that general markets are expecting will boost consumption. It's going to boost investment growth. It's very likely to continue, and it's going to be pushed forward at this upcoming NPC meeting.
Well, let's talk about what that specific policy means for the economy and the currency. So the report that you have written talks about how we could expect higher productivity growth in China, and as a result of that, renminbi appreciation. How does that work out?
Yeah, so I guess on the first point around productivity, this is going to come from China's shift to this higher value-added manufacturing. So as I mentioned, this semiconductor kind of push and the chips, electronics. What's going to happen, I believe, is that with this push in that direction is going to increase investment drastically into the country, whether that's local private investment or is going to be foreign investment coming through. And this should have a big effect in terms of raising overall productivity. Now, I'd just say that we've seen this happen in other parts of the world as well. In Asia, for example, the prime example is actually Singapore. It's been on different long-term productivity pushes over the past few decades, and we've seen this really have an effect, not just on raising productivity, which is its goal, but actually on the exchange rate as well. So I think it becomes a little bit more kind of theoretical around the impact of productivity and on the exchange rate. But the bottom line is this, is that if we have higher productivity in the manufacturing sector, or we classify that as the tradable sector, then this is going to result in higher wages, inflation in a non-tradable sector, and as a result of that, overall real effective exchange rate appreciation. So this is something that, for example, Singapore has pushed historically. China has been pushing this, and I believe that with this dual circulation strategy that's going on, and particularly this push into higher value added, we are probably going to see another burst of productivity ahead, and of course, as a result, the exchange rate actually appreciate on a real basis.
And that could lead to a more expensive CNH, or am I right in thinking, Craig, that if we have a productivity growth phenomenon taking place here, that actually feeds into our frameworks for valuation for currencies, right? So this will have implications on the way we view renminbi's valuation over the longer run. Is that right?
No, absolutely. So I would just say in terms of our valuation metrics for Asia and for G10 as well, we already encompass productivity adjusted real effective exchange rates. Now, this has actually become a kind of more important valuation metric from quite a few central banks around the world. I would say the one within Asia that's really been of focus has been India's RBI. The governor, or should I say the previous governor, Raghuram Rajan, has actually explicitly been telling market participants that, don't focus just on real effective exchange rate, focus on relative productivity and adjust the real effective exchange rate for this. And that's exactly what we've done. So I think this is going to be a much more important valuation metric ahead for China as well. Given that China is clearly going on this push towards higher value added, we're expecting productivity to grow as well. We do expect them to focus on this. So it won't just be about, hey, wait, the real effective exchange rate has actually appreciated quite strongly. It's going to be adjusting for productivity, which should then dampen the actual overall impact of the real appreciation. So I think this is very important. I would just highlight one thing, Jordan. I think this is quite important. At this current juncture, the real effective exchange rate adjusted for productivity is actually quite close to fair value. So that's important because when we look at just the simple rear deviation, it's actually showing that RMB is 7% overvalued. Now, what it tells me is that with the productivity adjusted real effective exchange rate close to fair value, it means that we can strengthen quite a bit more from here. And I think that's going to be much more of a focus for policymakers and eventually markets as we go ahead.
Albert, let's bring you in here. Craig's spoken about higher productivity growth being a part of the dual circulation strategy. If we get higher productivity growth, what does that mean for the story in China rates? Do we get consistently higher or lower local bond yields as a result of that?
Yeah, thanks, Jordan. So according to our analysis, so I think when there's a productivity growth, when we talk about the tradable sector productivity improvement, then the inflation in the tradable sector will probably go down. But at the same time, the inflation rate of for the non-tradable services sector may actually go up. So which factor is bigger? So I mean, in surface, in theory, because the service sector is bigger than the tradable sector, it is likely that on aggregate there could be some upward pressure on inflation rates. But I think there's also a couple of other things to think about, because when you have a strong productivity growth, I think your potential growth rates tends to go up. And so it may actually help to alleviate the potential supply bottleneck and reduces the risk of stagflation. And the other thing to think about, as we highlighted in the report, is that higher productivity growth may actually lead to a higher real effective exchange rate. So if we do actually get RMB appreciation in tandem with productivity growth, then it will help to reduce the risk of imported inflation. So overall, I would think that given the more likely to have a, let's say, stronger currency, lower import inflation, and more foreign inflow into China bonds. So net, I don't think the increase in non-tradable sector inflation will necessarily lead to higher bond yields. In fact, the more important factor, I think, is the high potential growth rate, less supply bottleneck, stronger offshore inflow because of RMB appreciation could actually lead to lower bond yields.
There's also a long-term part of China's strategy. Let's talk about the internationalization of the renminbi. It's come a long way since I first started working in FX. I remember when the negative carry of the carry and roll of the NDF for foreigners made it hard to have long CNH positions on without paying absurd or high levels of carry. And instead we had China proxies as our way to hold that position. So trading over currencies that were connected to China's trade flows. Well, that's completely changed with CNH, along with several other swap lines set up with international central banks and much more higher levels of exchange of the renminbi across borders. For listeners, Craig, I have to have a checkup on where renminbi is towards full internationalization. What have the authorities done so far? And then where is it likely to go next? I guess let's first talk about the state of the capital account. How liberal has it become essentially?
Okay, so I guess on this, I would simply say that kind of progressive liberalization is continuing. So on both the outflow channel and the inflow channel as well. I mean, we know that the current account is fully liberalized, but it's really about the capital and financial account that isn't. I'd just say that this has been something that has been pushed quite aggressively, I would say, since the past 2 decades in terms of liberalizing the capital and financial account. It has hit stumbling blocks. It's gone through different phases. For example, after August 2015, we had that one-off devaluation, and then, of course, the exchange rate adjustment as well, in terms of the regime. And then, unfortunately, we had a lot of US-China tensions building up as well and targeting of China. That really just threw things back. And we had a big tightening up of the outflow channels around the capital financial account. What I think is that under the Biden leadership, this internationalization goals of the Chinese government, this is going to result in much bigger liberalization ahead. So it will be on both inflows, which is what we have seen, but it will also be on outflows as well, allowing for more outflows. But I think on a net basis, when we're thinking on a multi-year period, given what's happening in terms of this productivity rise that we expect from this dual circulation strategy, and also from the internationalization of RMB, the net flow should be positive into China. So I think that's what's going to happen, even with the overall liberalization on both the outflows and the inflows.
When I look at the IMF's COFA data for central bank reserve managers, when I'm looking with my G10 hat on, we've seen 2 years of consistent, pretty consistent dollar selling by central banks. And in my space, that's been going mostly into yen, actually. What can we say for global central banks when it comes to renminbi, Craig? We've seen some swap lines set up, but what level of renminbi ownership have we seen from central banks?
Yeah, so the data actually is not very impressive. We have seen, I would say on a nominal basis, the dollar value of renminbi assets held by global central banks actually increase over time, and it's been pretty consistent, the increase on a nominal basis. On a total reserve basis, it's still quite low. It's still around, 2% of total global FX reserves that are held in renminbi. But I would just say that this is still very early days. I'd say that, as renminbi continues to develop around the world, it will definitely be in higher demand from global central banks. The one other thing I'd want to mention around this, which is quite important, is that central banks are only one component of this kind of global demand for renminbi. And global central banks actually are quite small in relation of other foreign investors. So just to look at the context of, let's say, foreign bond holdings, foreign bond holdings in the past 3 years has actually risen to a total amount now of $530 billion. Right? So $530 billion is owned by foreigners in terms of China's bond market. Global central banks' ownership, and I assume most of it's in bonds, right? In terms of FX reserves, it's only around 245 billion. So actually what's happened is that I'd say mostly the private sector has been the ones really driving this internationalization push that China has been going forward with. They've been the ones that have been really purchasing renminbi assets. But I do expect global central banks to certainly increase their holdings. We've seen previous surveys of global central banks which suggest that over a 10-year period, they're going to raise it to around 10% of the holdings. It's just that I think we've hit a little bit of speed bumps along the way with renminbi depreciation periods, trade tensions. Those haven't helped at all.
Well, we've talked about central bank reserve managers there, but there needs to be a motivation for the usage of renminbi in those reserves too, which is when renminbi becomes a large part of other countries' balance of payments risk. So the internationalization of renminbi, part of that will be to have more contracts in renminbi, invoiced in renminbi. What have we seen there, Craig, in terms of the invoicing of renminbi? What have we seen for the cross-border usage of renminbi and I guess deposit demand as well?
Yeah, so I think that's another part of the internationalization push as well. For sure, the renminbi trade settlement has risen pretty substantially. If I'm looking at, for example, the settlement that goes through Hong Kong, a CNH settlement, it's substantial. It now accounts for, so the amount of CNH that's actually settled for trade now accounts for 20% of China's total trade, imports and exports, which is gigantic. Now, it had hit a stumbling block after the 2015 deval, and then of course when we start to have all the trade-related risks coming through as well, and we fell to around 15% of China's total trade. But we're getting back to levels pre-August 2015, closer towards 30% of China's total trade. I think that's the path we're going on. And I do believe that over the coming years, we're going to quite easily break through that. So it's very clear that global trade partners are increasingly using renminbi as the, if you want to say, the exchange for goods for trade. And, I think this is very impressive. The other thing is around deposits, as you mentioned. Now, this is more the kind of retail side. So before we talked about global central banks, we talked about real money, all those institutional investors. The retail side is the other part of it as well. And back before August 2015, we had been seeing trends around retail investment actually buying up renminbi so big that we had problems in the region, such as the size of the flow was almost the same size as, for example, South Korea's current account surplus. So it was pretty drastic in terms of impacts on regional BOPs. We're not seeing that yet, but I would just say to you that the evidence we've seen in the past few months is that renminbi deposits, whether it's in Hong Kong, whether it's in Taiwan, or whether it's in Singapore, or whether it's in Korea, are actually picking up again. And I think I would expect that to continue to be a trend over the coming years as well.
Albert, we've spoken in the past about how China local rates, they've been very idiosyncratic. And by that, I mean, they've not been too correlated to the global move in rates, driven mostly by what happens in the US Treasury curve. Now, with foreign ownership of China bonds increasing, could that story about China's idiosyncrasy when it comes to rates change anytime soon? Essentially, Albert, could we see the hot money flows introduce a new element of volatility in the China curve?
Yes, I think we have definitely spoken about it. And in fact, it is again playing out over the past couple of weeks when you see China rates have actually been very, very stable when US rates and other rates actually move up substantially. So I think as we discussed again, the reason why that has happening is because China is well ahead of other markets in terms of rebound from COVID and in terms of policy rate normalization. So China has already done its bit. It is more the other markets that are catching up now. And so when the other markets normalize, it doesn't mean that the China rates have to move again. So I think that is why you are still seeing China rates seemingly decoupled from the global sell-off in recent weeks. Now, but the more important thing, I think, when foreign bond ownership continues to increase, China bonds will inevitably, China rates, become more correlated with the global business cycle and the global rate cycle. So I think that the Chinese authority is aware of that. So they will try to manage the volatility with respect to hot money flow.
And there's a longer term story as well when it comes to something that's quite exciting, and it's China's push towards a digital currency. How soon do you expect the rollout of that digital renminbi to be, Craig?
Yeah, I mean, it's certainly a push from the PBOC. It's one of the central banks around the world which is really pushing this digitalization. It's kind of tricky to really call the timing of a real kind of broad rollout. It's still in kind of test phase in a few regions in China. I would just simply say that probably quite soon, over the coming months, I would expect that to be rolled out in even more regions within China, then broadly the whole of China, before moving towards maybe Hong Kong and then other international centers. But I think this path towards digitalization of renminbi is going to continue. It's going to be very significant because it's going to be increasing the dominance of renminbi again around the world. And I think what this will mean is that it will take up a bigger kind of status within global FX reserves as well.
Well, let's talk more on the flows and trading views. We can have the best macroeconomic framework in the world, but if we lose track of the flows, the trades can just completely fly out the window. And with all of the above, we've just spoken about the dual circulation strategy, the internationalization strategy, the sort of long-term bullishness for China story is pretty clear, especially with the aim to boost productivity, which would allow a stronger currency, even with RMB being adjusted for, it wouldn't be expensive as a result of that productivity growth. So Craig, what can we say about the state of FX flows right here, right now?
So right now, it's certainly positive, almost on every single angle. I would say that bond inflows is probably one of the key inflows at this point in time. We've recently had data for February, but if I just accumulate, let's say for the past 3 months up to February, we've had around $75 billion of inflows from foreigners into bonds. That's bonds alone. And I think that, as you move forward, it's going to continue to remain strong, particularly as you go into probably around the third quarter of this year because of index inclusions, right, that are going to come through. But then there's other forms of flows which are very powerful right now. We had evidence and more evidence that exporters are remitting a lot more dollars back onshore. And that was something that was kind of missing for a good part of 3 quarters of last year and has actually started to pick up and remain pretty consistent. So I think that's also another very powerful driver of renminbi and very strong flow as well. Equity flows, it's been a slight difference in story. Now, we actually had very large outflows on equities, particularly in January. But towards the end of January until now, we've actually seen this stabilize pretty significantly. It was one factor actually which offset the bond flow. It was that large, the bond inflows. But now we're starting to see some stabilization in terms of the outflows from China, which then clearly means that the other sources of inflows will now become a kind of more pronounced driver of renminbi. I just want to mention one last thing, Jordan. I think it's quite important. It's not just about the inflows, but it's about the outflows as well, because China historically has suffered from a lot of outflows. With the COVID shock that has hit the world and hit China as well, it's very clear to us in the data that China's outbound tourism has been very weak. If you're looking at just historically, outbound tourism is annualizing around close to $200 billion a year. We're running about half that rate right now. So there is a huge constraint on the tourism side versus history. And then because of this inability to travel outward as well, what we've also seen is this errors and omissions, the kind of unknown sources of capital outflows in China, drop off substantially as well. Again, running about half the rate that it was running pre-COVID. So it's very powerful inflow dynamics right now, but outflows are kind of constrained. So that's what makes it such a kind of favorable net flow dynamic at this point in time.
Oh, that's really interesting, Craig, because I want to play devil's advocate here and just ask a few questions about where there could be a risk to this bullish China view. We mentioned how productivity growth could boost the value of the currency. The internationalization effort also should push this too. But a strong currency could weigh on the post-COVID-19 recovery. Many countries would like to avoid a strong currency if they can, typically in this stage of a recovery. And you mentioned those flows there on tourism and the net errors and omissions. With a reopening coming up, couldn't that see those flows kick back in, and it kind of, the dollar CNH has been going sideways. So I just want to understand what's going on. Why is it trading the way it is more recently?
Yeah. Well, let me answer your first part, which was around the strength of the currency and the risks around that. So I would say that, from the analysis that we have done, and plus a lot of literature that we have also analyzed in terms of the currency impact on China or the trade situation, actually there is no real strong evidence that there is a detrimental impact from currency appreciation. I'm going to say that a kind of main reason why a lot of literature highlights that fact is that they see a lot of kind of import content in its final goods. So on one hand, you have a strong currency, which actually cheapens up the imports. But on the other hand, of course, it impacts on the actual export demand as well. So the net impact actually is probably not so significant. And plus, I would say the other thing is that, if we are moving into, much higher, I'm talking about longer term here, if we're moving into much, higher value added goods, then I think the price sensitivity around it probably will drop off quite a bit. And of course, if you want to say the kind of margins and impact on firms will probably be a bit lower as well. So, I think that just kind of comes back to what we were saying about, productivity. It's going to be absolutely key, right, to see this strengthen, whether it's in the quarters ahead or the years ahead, because if we're wrong about that, it's clearly going to be a risk and a negative impact from real effective exchange rate appreciation. But again, if we're right about it and that we do see productivity rising, then I think the impact on the overall economy actually be pretty limited. So just on the recent moves on RMB, I think the problem that we have faced, RMB's actually performed pretty well on a relative basis. So on a trade weighted basis, actually it has been strengthening. But on a dollar China basis, it's really struggled, as you said. It's kind of been sideways. And I think that's just a function of what's going on recently in terms of the reflation, inflation theme, higher real nominal US rates and the impact on the dollar. I think that's really something that's, affected the whole dollar Asia complex, including dollar China. But on a trade weighted basis, it's quite clear, or even on a cross basis, it's quite clear that RMB has been performing relatively well.
Well, then how should investors take advantage of all the views, Craig? Is it short dollar CNH? Is it short euro CNH? Is it long CNH yen? Or is it something else?
Well, the way that we're thinking is that with this real big push in terms of this dual circulation strategy, which will raise productivity, as well as internationalization, people can talk about internationalization being good, but there's a cost of it as well. The cost, to some extent, is appreciation of the currency on a trade-weighted basis. So these themes, these long-term themes, plus what's happening on the dollar front, really suggests to us that in the near term, we can see RMB actually perform on a trade-weighted basis. But on a more longer term, there's a lot of arguments that people have been putting forward that, hey, we're reaching levels on a trade-weighted index, which suggests that we're being, we're very strong. But again, if we're right on this productivity argument, actually, we will be breaking higher levels on the trade-weighted basket. So I think trade-weighted basket at this point in time does make sense to me to be, long the trade-weighted basket, or at least expect the trade-weighted basket to appreciate. I think that's probably going to be the successful direction over the medium and long term.
And that's a wrap. Thank you for joining the podcast.
Thank you.
So those are the views from us, those are the trades from us, and that's the Fireside with Craig Chan and Albert Leung. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers and investors, please like and subscribe to Nomura's podcast on Apple, Spotify and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice. preferably a nice one, and please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.